Happy St. Patrick's Day. From our morning reading of the headlines, volatility has been high over the past few months considering how well stocks have held up. The S&P 500 has endured 20 days with a daily change of more than 1% during the past 3 months, one of the largest clusters in history. But precedents don't lead to anything consistently negative. Indeed, if you look more into the details of this, one of the concerns that bullish investors have had lately is the plentiful number of large moves in stocks, despite what has been an overall bullish trend. The concern is that a higher level of volatility is a sign of increasing uncertainty among investors, a discomfort with stocks valuations, and a precursor to even more volatility or a likely correction even. That is theoretical, textbook thinking. What we're looking for is anytime the S&P 500 was trading within 2% of a 3-year high, and it had moved more than 1% up or down on at least 20 sessions during the past 3 months. Well, this actually has occurred a number of times in the last 30 years, and actual history is not in agreement with what the textbooks suggest. The increase in volatility from a multi-year high did lead to a couple of really bad declines in 87, 2007, and 2000, kind of. But other than that, the returns were positive. We're not reading anything bad about this uptick in volatility. There just is no edge in reading that just because you have an uptick in volatility that you are about to have a correction. This is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:18 a.m. Central Time, and I am recording this in preparation for the market day, March the 17th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, we also had some pretty interesting things happening in the overnight. You see the broad market indices are slightly weak at the time of this cut, down about a quarter to a third. Nothing too dramatic. Where the dramatics came in was in crude oil once again. If you thought you had found the bottom in crude oil, you've got another reset. It was down 1.85%, down almost $1 in the overnight. Euro is up about a quarter. Bonds up healthy 1 and 4/16 or 8/32, however you think of that. About 0.78%. Gold up slightly. In the overseas markets, China up big, 1.56%. Hong Kong going the other direction, down 0.2%. Japan, much like China, up about 1%. Europe also mixed, with Germany down over a percent, and the FTSE in the United Kingdom essentially scratched. So really variable activity in our own markets, though slightly weak at this time. For macroeconomic reports for Tuesday, we have housing starts, an orange flag report. Other than that, pretty quiet today. For tomorrow, we have, of course, FOMC has begun, and we'll have a statement released tomorrow, Fed funds rate. So that will be a major mover for the entire week. You also have crude oil inventory tomorrow morning. So that's probably the big mover. Obviously, everybody's waiting to see if they remove the word patient from their statement, and we'll likely have a direct reaction to that expectation. In terms of volatility, we did have some pretty big move yesterday, and both the S&P and the Dow with more than a standard deviation move on those two markets. Volatility I was actually playing around, did some kind of odd things yesterday. We had short-term volatility at 16.15, and if you look at the relationship between the short-term volatility and the regular VIX, we've got for a big up day, there was some pretty unusual relationships going on here. So just kind of be aware of that, probably directly related to the FOMC expectation. In terms of our regular daily report, we still have uptrend under pressure and a GMI index of 4 out of 6. So our investor posture is bullish, but with some cautionary tones to it. Active traded posture is really quite mixed. I've got bearish here, but as you'll see down below, we'll get into greater details. It really is quite mixed. From a position sizing opinions, long side portfolio exposure up to 50%, and a call to not initiate new bullish positions. Again, this is pretty mixed. Bottom line is, from a position sizing, if you do initiate a new position, you should probably consider a reduced position size and only the strongest setups as we enter the FOMC statement period. From a volatility metric, it still calls for 75 to 100%. Market timing is neutral for today and the 3-day outlook, and really until that FOMC announcement comes out, probably will be relatively choppy and directionless, and certainly not with a lot of edge. If we do get a move one way or another, be careful about what size targets you use and these kinds of things until we get that statement. As you see in the market posture, and this is part of why we say it's kind of mixed, the S&P actually just barely curved bullish, and is now signaling that it's okay to take new short-term or intermediate-term trades, as does the Russell. But the Dow and the NASDAQ are still bearish, so a lot of cross currents coming across the market posture, and never good when your broad market indices are going in opposite directions. It really does not lend to high probability trading on any kind of swing or intermediate term time frame. Hedge warning status still remains threshold level 1, yellow or cautionary behavior, tapping those brakes. Volatility base, and this is part of what I was talking about in terms of that short-term and intermediate-term volatility metrics. We actually flagged market and decline warning and a sharp increase warning, even on a day that was actually quite bullish. If you look on the charts, the candlestick patterns, these kinds of things, yesterday was quite bullish, and yet we had these warnings flag off, and that comes back to probably an increase in volatility that was in anticipation of FOMC is my best guess. Current number of distribution days remain high at 5 and 5 for the S&P and NASDAQ, so that is also a cautionary statement. And we still have on our intermediate trend, the most recent swing was a lower low, so that is not good for a strong bull case. New highs, new lows. I left this in red. The day before it was in red because we had over 300. We were right at 300 new monthly lows on the New York Stock Exchange. So this was really quite mixed, but certainly is a cautionary area at this point. Nothing else really of change in terms of our intermarket indicators. Also, our opinions for option income strategies, covered calls, and put selling all remain the same. VIX is inside the acceptable window, allowing for option income strategies. Obviously, you have FOMC once again, so position sizing and timing of entering new positions should be considered. In terms of covered calls, still playing for that equal distribution between in the money and out of the money strikes, and on put selling, looking for those dips, those opportunities to sell puts against the core portfolio stocks that you are willing to own. And let's drop down here to the other parts that were updated for today. Sector market posture, a lot of mixed signals here, and this is what you get when you get these kinds of range kinds of trading markets. One day everything looks great and things start greening up. The next day it rips right back down and turns very red on lines that are very much horizontal. So mostly look for what is most consistent in its performance. Healthcare certainly, retail have been pretty consistent as their performance, whereas energy is very, very volatile and going back and forth. Utilities also has been trying to find a bottom, so they tend to be some of the weaker performing sectors. From a percentage yesterday, obviously materials and utilities were down. Utilities really the only one down of any significance, but the fact that utilities was down 1% on a day that the broad market was so strong, and actually looks like there's something wrong here. I'll have to check that. I got utilities at 1.7 and utilities down 1.01, so something came off wrong on the cut on the data there, so I'll have to check into that. Bottom line though, a fairly good day yesterday, and but this morning a little bit of weakness, so we're kind of continuing this crisscross activity. Top industry groups remain are, well, it looks like biotech's moved up a notch to number 4. It had been running at number 6. Retail, railroads, internet, now biotech, healthcare, and transportation make up your top group of industry groups. Biotech has been actually quite interesting of lately, has been holding up in a relative performance really quite strong. So you should take a look at either a sector ETF type play or some of the better individual plays. One of the things about biotech, of course, is that one FDA announcement can make you a hero or an absolute heel. So one thing to consider is doing something like an ETF IBB or something along those lines, to where you can play the group without having too much exposure to any individual one player in a very, very volatile sector or industry group. So something to consider there. As always, greatly appreciate your liking us on YouTube or your other favorite social media platforms. Additional information is always available on the website, falconglobaltraders.com. You can send support, questions and so forth at support@falconglobaltraders.com is the email address. Disclaimers as always, just hit the pause button if you need more time to read this. And then, of course, we greatly appreciate you each and every day, and the Falcon Global Trading community. We'll look forward to seeing you here tomorrow, Wednesday morning, for our next report. Thank you.